All right, great. Let's go ahead and get started, guys. Welcome aboard. Happy Friday. This is Ilian Yotov. I am the founder of allthingsforex.com and tradertape.com and the host of the popular daily All Things Forex broadcast, which you can listen to daily on my website, allthingsforex.com. Thank you to our friends at FX Street for putting together these series of webinars. And what we're here today to discuss is the upcoming trading week, which is going to be a very busy trading week, by the way, with a sequence of important economic data from the United States. In other words, the next week is going to be all about the U.S. dollar, the state of the U.S. economy, and also the Federal Reserve's future monetary policies. As we see a strong sequence of economic data from the U.S., I'll normally give you, as many of you know, the top 10 spotlight events that I feel are the most important economic events, or geopolitical events for that matter, that will move the markets every new trading week. Out of the top 10 events next week, 9 of them are from the United States. So just an example as to how busy the trading week ahead is going to be with important economic data and a monetary policy announcement from the Federal Reserve, the U.S. Central Bank, in the week ahead. So, but before I start with the top 10 events, I want to start with what I started the program last week. And I want to show you a chart. In particular, I want to show you the daily chart of the dollar versus the Japanese yen. Now, if you recall, those of you who follow the program on a regular basis, I spoke about something that I discuss and in my book, The Quarters Theory, and something that I have developed which is based on the classic Elliott wave theory, which, for the lack of a better word, I call it the Quarters Theory trend waves. Of course, they're based on a classic Elliott wave theory. But the big difference that I bothered you to explain last week is that in my Quarters Theory trend waves methodology, I do not limit the number of waves that we can see in the same direction. For example, in a classic Elliott wave theory pattern, we see 3 waves in the same direction. Wave number 1, 3, and 5. And that's perfectly fine, but we know in reality we don't get to see always the classic 3 waves in the same direction following each other. We can see less than 3, and in some instances we can actually see more than 3. So I wanted to bring your attention again in a program today because it was a great lesson, I think, for some who follow this webinar, because I hope that you have learned something new from what I discussed last week and what I'm following up with this week. Because, as I gave you the example last week, what is an classic Elliott wave trader to do when they see the dollar-yen daily chart, for example? Here's your latest, freshest new bullish trend wave, as I call them, starting number 1, bullish wave, correction following it, wave number 2 right here. Again, to specify for those of you who are new to this program or missed the program from last Friday, another difference in my version of the Elliott wave theory patterns is that in my trend waves, I do not give an actual number to the price corrections that follow a previous trend wave. In other words, if this is the first bullish wave and this is the price correction following it, I call it what it is. It's a price correction, not an actual trend wave. It helps me and also thousands of traders who benefit from my Quarters Theory around the world to focus on the trend waves that actually progress the trend rather than regressing it. Because we know that price corrections do occur, but they're pullbacks in the opposite direction of a previous trend wave. So it also helps with the proper counting this methodology also helps with the proper counting of the actual trend waves. And some of you will say, okay, so what's the point here? Well, here it is. It's pretty much what I was discussing and bothering you with last Friday, because I explained that in my book, The Quarters Theory, and in my Quarters Theory methodology, I do not limit the number of waves. So instead of anticipating 3 waves in the same direction, I said, and I explained in my book also, that if you limit the number of waves, then a trader could get in trouble. Why? Well, because they may anticipate that after perfect 3 bullish waves, or 3 waves in the same direction, they can also be bearish, depending on the trend. In a case of the dollar-yen currency pair, this is a bullish trend. So you have a very strong bullish trend wave sequence. And if a trader was anticipating that after 3 waves, this trend is going to come to an end, then guess what? And they're, ultimately they build a strategy where they consider to take advantage of a more significant price correction in a classic Elliott wave pattern. The wave number A, B, and C are the corrective waves that cause that more significant price correction. Well, then, guess what? After the perfect 3 bullish waves we had last week that I pointed to you, a 4th bullish wave that had developed. Here's wave number 1, correction following it. Wave number 2, correction following it. Wave number 3, correction following it. And then wave number 4. What is a classic Elliott wave trader to do here? They scratch their heads, obviously, and they ponder. Okay, what number of wave is this one? Well, very simple. It's wave number 4. But wait, wasn't that supposed to be wave number A, B, and C following each other? No, not really. In a perfect world, maybe. But in an actual world, now we have an example last week where we had a 4th bullish wave. And guess what? This week, especially in the last couple of trading sessions, we have another example of yet another bullish wave in the same direction. Wave number 5. So now we're 2 bullish waves over the classic Elliott wave pattern. Which is my point exactly, that as to why you should learn from this example and buy my book and learn more, if you like, about my version of the classic Elliott wave theory that I call the trend waves, or the Quarters Theory trend waves, for the lack of a better word. So here we have a classic example, perfect example of 5 bullish waves following each other. Obviously, a very strong bullish trend, but becoming even more extended after we see a number of these waves beyond the classic 3-wave pattern. Obviously, we're now in overextended territory as far as an actual development of these trend waves. And I'm spending some time on a dollar-yen currency pair right at the start of the program, because later on we're not going to have time to take a look at this currency pair in closer detail, because I will spend the next 20 minutes talking about the important events of next week and taking a look at the pound dollar and the euro dollar currency pair. And so I wanted to start off with this example, which I think that it's a good example. It's a great lesson for traders, especially those who want to learn about Elliott wave methodology, which is great, and the Elliott wave theory. It's a very, very important part of the trader's education to know that. But I feel that my version of the classic Elliott wave theory, the Quarters Theory trend waves methodology, is also important and helpful for a trader to learn. And I wanted to bring your attention to this example. 5 consecutive bullish waves, overextended bullish trend for the dollar versus the Japanese yen, also very, very strong. And as I showed you also, and I talked about this last Friday, in my book, The Quarters Theory, I actually give example of 7 consecutive bullish waves or bearish waves. I give you both examples in the book, following each other, which is more than twice the amount of the classic Elliott wave pattern of waves following each other in the same direction. So keep that in mind. If next Friday we talk about, well, actually we're not going to have the webinar next Friday because we don't have these Outlook webinars on non-farm payroll Fridays. But if we talk about 2 Fridays from Friday after next, about the 6th or 7th bullish wave that has developed on the dollar-yen daily chart, don't be surprised. Also, on the other hand, as I also warned last week, don't be surprised if a more significant price correction is to start kicking in at any given time. Things are overstretched, overextended right here. Obviously, that's a warning sign, but when the trend is strong, we could see these kind of overextended bullish and bearish trend wave patterns developing when we get to see strong trends being established. So, just an example, a little education at the start of our weekly webinar outlook. All right, so let's start with the first of the top 10 events. We have had some sequence of very upbeat housing market data from the U.S., well, with the exception of the existing home sales earlier this week, which were not as strong as the market was forecasting. And now the new home sales also for December were not as strong as the market was forecasting. But for the most part, in the last few months, we've seen some promising signs of a recovery in the U.S. housing market, which, as I explained previously, I'm not surprised because it's closely linked with a recovery in the jobs market. So we've seen also the jobs market improving in the U.S. So obviously with the record low interest rates and the job market showing some signs of improvement, it won't be shocking to see the housing market improvement occurring as well. So that's what we will watch for in Monday's report of the pending home sales index. Is that improvement going to continue? Well, the consensus forecasts are expecting another month of increase in pending home sales, which is, of course, a leading indicator of housing market activity because it's not it only measures contracts that have been signed to purchase a home, not closed home contracts. It's just a sort of a leading indicator of pending home contracts to be sold. A 0.5% month-over-month increase is expected for the month of December, which is going to be lower than a 1.7% increase in the previous month. So it more than likely will be in line with that pullback that we saw in the existing home sales for December and also the new home sales for the month of December as well. So we could start to see the 3 housing market reports from the 2 from this week, existing home sales and new home sale, and also the pending home sales index showing a little bit of a pullback. Of course, just a temporary pullback for a month doesn't necessarily mean a new downtrend emerging, perhaps a little bit of a pullback after several months of increases in all 3 of them, pending home sales, existing home sales, new home sales, housing starts, and so forth and so on. But obviously, that could be a little bit of a red flag, maybe the beginning of a new downtrend emerging, or simply just the price correction, a little bit of a pullback. Then we're going to pay attention to the Consumer Confidence Index, which is coming up on Tuesday. And the outlook of U.S. consumers is expected to also get a little bit softer, a little bit less optimistic than the reading of 65.1 that we saw in November. For December, the Consumer Confidence Index is expected to show a reading of 64.5, so a little bit less than a 65.1 in the previous month. Then we're going to see the ADP Employment Report, which is the report that is compiled by the Automatic Data Processing, the largest payment processing company in the United States, which is a gauge of job creation in the private sector of the U.S. economy. That usually comes a couple of days before the non-farm payrolls report, which is going to be the big event of next week. The ADP non-farm employment change is expected to show the private sector of the U.S. economy creating a little bit less jobs than it did in November. In November, we saw 215,000 jobs created by the private sector. In December, we could see 164,000 jobs is the consensus forecast. So slower job creation. So what can we gather from the first 3 of the top 10 reports so far? Well, if the consensus forecasts are accurate, they're not going to show a whole lot of strength from the data in the first three reports from the U.S. So we could start seeing some perhaps warning signs, because we've seen a lot of optimism rally and so forth and so on in recent months, which has been in line with the improvement in the jobs market, in record decline in jobless claims to a 4-year low, 5-year low, even lower since 2008 before the crisis even started, which was a great report yesterday. But beginning next week, be cautious, because we start seeing some of these red flags, especially if the data comes even softer than what the consensus forecasts are expecting. And ultimately, this could be a drag, if you will, on investor sentiment and ultimately on risk appetite as well. The biggest drag perhaps on sentiment and confidence in the state of the U.S. economy could become the GDP report from next week, which is the preliminary estimate for the gross domestic product in the fourth quarter in the United States, fourth quarter of 2012. That is. Now, earlier this morning, we saw a very bothersome sign from the UK economy, which is in line with what we discussed last Friday. Most of the consensus forecasters were expecting that the United Kingdom's economy is going to contract in the fourth quarter of 2012. And that is what we saw. We actually saw an even larger than anticipated contraction. Consensus forecasts were expecting 0.1 or 0.2% quarter-over-quarter decline in the UK in the fourth quarter. We saw 0.3% quarter-over-quarter decline, which means that the United Kingdom's economy only grew in the third quarter of 12. It had 3 consecutive quarters of contraction before that, which was the double-dip recession in the UK. Then it returned to growth in the third quarter of 2012, and then conditions deteriorated again with the economy contracting in the fourth quarter. So now we have more and more people saying what I've been saying previously, and that is that the UK economy may be on the path of a triple-dip recession. Well, when we take a look at the consensus forecast for the preliminary estimate for the U.S. GDP report, GDP growth in the fourth quarter, it seems to me like consensus forecasts are expecting the U.S. economy to grow at a much slower pace in the fourth quarter of 2012 than it did in the third quarter. In the third quarter, the U.S. grew by 3.1% quarter over year. 3.1% was even stronger than expected growth. But the consensus forecasts are expecting the U.S. economy to grow by 1.3% only in the fourth quarter of 2012. Obviously, a significant slowdown from the growth in the third quarter. So this could be yet another economic report, as I said earlier, number 4, that is softer than it has been in previous months. And we can start seeing the economy softening in the U.S. Then, the big event of next week is coming out shortly after the GDP estimate on Wednesday morning, with the Federal Open Market Committee interest rate announcement, or monetary policy decision, call it what you will. That is due at 2:15 p.m. Eastern Time on Wednesday, January the 30th. And I am not expecting that we're going to see a whole lot of surprises with the Fed's decision next Tuesday, simply because... Hold on one second. I'm just trying to get to something which the technology is really not cooperating this morning, I must say. Okay, here we go. I think everyone knows what the Fed's monetary policy currently is. A record amount, massive quantitative easing, record low interest rates. The Fed's promised that they're going to keep the rates low until late 2014. And so I'm not expecting that there's going to be a whole lot of surprises by the Federal Reserve on Wednesday with their monetary policy decision. I think they are all in now with open-ended quantitative easing, unprecedented, never before seen amount of emergency monetary policy measures. And as of today, the Federal Reserve and its unprecedented bond buying has pushed the Federal Reserve's balance sheet to a record $3 trillion, a level never before seen. Just to give an example, the Fed assets were below $1 trillion on September the 10th of 2008, which was the week before Lehman Brothers filed for bankruptcy, and obviously, you know, the rest is history. We witnessed the worst global financial crisis in, 70 years. So the Fed's assets were at $924 billion on September the 10th of 2008. Now they stand to $3 trillion. And the Fed is showing no signs of slowing down, which means that some are estimating that by the end of this year, beginning of 2014, we're more than likely going to see another $1 trillion being added to the Fed's inflated balance sheet. $4 trillion, from $3 to $4 trillion. So it's not very difficult to conclude that if the market is pricing in that the Fed is going to continue to press the pedal to the metal when it comes to quantitative easing and record amounts of money printing and bond buying and so forth and so on. The Fed, by the way, as you know, is purchasing $85 billion of securities every month. So it wouldn't be very difficult to make the assumption that the U.S. dollar could stay under pressure if the Fed reminds the markets or assures the markets that quantitative easing and this massive, aggressive quantitative easing is here to stay. This is why we should not be surprised that the euro is actually finding some bidders in recent trading sessions. And now let's take a look at the daily chart of the euro-dollar pair. And producing a bullish breakout today, which is an important technical development when it comes to the trend progression of the euro-dollar exchange rate. I drew the lines here a couple of weeks ago to show you that the euro-dollar pair has established a weekly range roughly between an important level in my quarters theory, which is the large floor point at the $1.3250, the lows at $1.3255 on January the 16th. The low was serving as the bottom of that range, and the top of the range was $1.34 level with the high on January 14th at $1.3403. Well, I explained that the only way we're going to see the euro-dollar pair giving us a more definite trend direction is if there is a breakout one way or the other, whether either above the top of this range or below the bottom of the range. And with the dollar already coming under pressure ahead of the Fed's announcement next week, which of course was not shocking, I said that last week if you listened to the program, the euro is finding the catalyst to produce a bullish breakout outside of that range, above $1.3403, reaching as high as $1.3473 in a trading session today, which is also not a coincidence because, as I explained previously, we're now seeing the euro approaching $1.3485, which was a previous level of resistance, and it was the 2012 high for the euro versus the US dollar. A very, obviously, needless to say, this is a very, very important long-term resistance level that the euro is approaching in a trading session today. And as I've explained weeks ago on this program, and also if you listen to my All Things Forex daily broadcast, a break above the 2012 high, which is going to be a very bullish technical development for the euro versus the dollar, because it will mean that the euro is not only breaking above an important resistance level, but also breaking above the high of the previous year, which, you know what the definition of an uptrend is. Higher highs, higher lows. So if you end up getting a higher high in 2013, this could be a sign of potential further gains for the euro versus the dollar. And my rule of thumb from my personal experience, which spans about 13 years now, if not even 14 actually, since we started a brand new year a month ago. From my experience, when we get to see a decisive breakout above an important yearly high or long-term support or resistance level, or yearly low for that matter, this could mean that a currency pair that breaks such an important level could gain hundreds of more pips. Now, I cannot give, it's practically impossible for us to predict how many hundreds of pips the euro could gain if $1.3485 is broken. Decisive. And that's very important. I'm not talking about an overshoot above $1.3485 going to $1.35, which is the important level there. Everyone familiar with my course theory knows what $1.3485 high of 2012 means. It's the euro meeting resistance at the large quarter point at $1.35, which served as a major resistance level at that time. But if this area of resistance, the large quarter point $1.35, the 2012 high at the $1.3485, are broken decisively above, not just overshot by a few pips, but broken decisively above, then that could mean further gains of hundreds of pips for the euro versus dollar. Perhaps a move to $1.36, $1.3750 area, which would be the next large quarter point that the euro-dollar pair could challenge. Those could be the implications of what might become an impending breakout, especially next week if the Fed continues to give further impetus to U.S. dollar selling. Provided, of course, that the party continues and the markets continue to rally and the investor sentiment continues to be positive and the Fed continues to provide the so-called easy money. And as I said earlier, I don't see any signs that the Fed is going to stop providing easy money. So the party could easily continue forward. And along with that, especially now that we're starting to see some optimistic signs from the Eurozone economy, then the euro could continue to find bidders and become a better alternative to the dollar. So we may have an important, not we may, but we do have an important resistance level ahead of us when it comes to euro-dollar exchange rate to pay attention to throughout next week. And we'll see whether next week is going to provide the catalyst that is going to be a much-needed catalyst for the euro to break higher above the 2012 high and then, obviously, as I said earlier, gain further. Hundreds of pips. Can't tell you what it's going to be, 100, 200, 500. With the dollar-yen pair, for example, when we had a break above the 2012 high, which was 84.17 yen, the breakout so far is producing, 700 pips of a gain? A little bit overextended, as I pointed at the start of the broadcast, but an example as to what a long-term bullish breakout could give you. And that's why it's crucial to pay attention to $1.3485, $1.35 area when it comes to euro-dollar exchange rate. Now back to the, obviously see if the euro fails to produce a decisive breakout above this 2012 high, then we could see a pullback, we could see a move back to the top of that range at $1.34, which is going to be a support level. It's going to be challenged. And if the euro breaks below $1.34, it is going to simply re-enter that previous range between $1.34 and $1.3250, and could fluctuate sideways again for a number of days. But I think the euro looks, to me at least now, is definitely showing some bullish momentum, and if it finds the catalyst to break higher above $1.35, I think that we could have a long-term bullish breakout that could be followed by hundreds of pips of gains for the euro versus the dollar. Following the Federal Reserve's announcement and the only economic report or event next week, rather, which is not going to be from the United States, is the Reserve Bank of New Zealand interest rate announcement, which is coming up on Wednesday at 3 p.m. Eastern Time. I am expecting the Reserve Bank of New Zealand to also maintain the status quo. I'm not expecting that they're going to make any changes to their monetary policy. And ultimately, it could become a bit of a non-event, but it could weigh on the New Zealand dollar if the Reserve Bank of New Zealand turns out a bit more dovish, sort of like what the Bank of Canada did earlier this week. Many still anticipate, and actually I'm one of them, who's anticipating that the Bank of Canada is going to be the first of the major central banks to start hiking interest rates. But if that expectation is pushed a little bit forward, instead of maybe late 2013 into late 2014, then obviously that could weaken a currency. And we saw the Canadian dollar actually coming under pressure as a result of that. These expectations for a rate hike by the Bank of Canada to come later in 2014, and we could see the New Zealand dollar also being pushed lower if the Reserve Bank of New Zealand, which, by the way, is the second most likely candidate after the Bank of Canada, to me, to my estimates, of course, in my humble opinion, I think the Reserve Bank of New Zealand is the second most likely candidate of the major central banks to start raising rates in the near future. But if that is not what we hear next Wednesday from the Reserve Bank of New Zealand, if they say that interest rate hikes or monetary policy tightening is going to be postponed for a longer period of time than what the market's anticipating, then that would weigh on the New Zealand dollar. But then we'll continue the sequence of U.S. economic data with the personal income and outlays. This is an important report not only because it tracks income and consumer spending here in the U.S., but also because it contains the Fed's preferred measure of inflation. And that's very important to monitor from now on, any kind of inflation gauge from the U.S., because as you might recall, the Fed gave us two exact numbers as far as what is going to be a particular specific level of inflation that could make the Fed to stop that open-ended quantitative easing that they're doing right now. And that is 2.5%. The Fed said in December, if the inflation increases over 2.5%, then when they're going to stop the aggressive quantitative easing. And also the other gauge, of course, was the unemployment rate. If inflation exceeds 2.5% or the unemployment rate falls below 6.5%, then that would signal the end of the aggressive quantitative easing. We can start seeing monetary policy in the U.S. beginning to tighten. Well, obviously we're far from these levels, both for unemployment rate. Unemployment in the U.S. is 7.8%, and inflation is, what was it, 1.8% on the CPI report last week. So we're not at these levels that are going to signal the end of the ultra-accommodative monetary policy and aggressive quantitative easing. But the Personal Income and Outlays report, which comes up next Thursday morning, contains the PCE price index, Personal Consumption and Expenditures Price Index, which is the Fed's preferred gauge of inflation. And that's why it's important to watch that report. And the core personal consumer consumption expenditures price index is expected to only increase by 0.1% month over month after being flat 0% in the previous month. That's not going to be the type of increase in inflationary pressures that changes the Fed's mind all of a sudden to stop doing and implementing their aggressive quantitative easing, other stimulative monetary policies. So I think that the report is simply going to give the green light for that, coupled with the Federal Reserve's announcement on Wednesday and inflationary pressures, if they are not increasing as much as expected, then obviously we could see expectations the Fed will continue and stay the course, continuing to be priced in the dollar exchange rate going forward. Then we're going to move on to the main event of next week after the Fed's announcement. That's going to be the non-farm payrolls and employment situation report. That's always an extremely important report because it's the main indicator of the conditions of the U.S. economy and the labor market. That's due next Friday at 8:30 a.m. Eastern Time, and the forecasts are expecting another decent jobs report next Friday, with the economy adding up to 168,000 new jobs from in January, from 155,000 in December. So obviously stronger job creation, and the unemployment rate is expected to stay unchanged at 7.8%. So if that is the case, we could have another decent report. Some of the less optimistic forecasts are expecting 156,000 jobs, which is only 1,000 more in January than the jobs created in December. But all in all, as long as we continue to create more than 150,000 jobs, I think that's in line with the trend of improvement that we witnessed with the non-farm payrolls reports in the last few months, and also with the jobless claims in the last few months as well. In other words, if the job market continues to show signs of improvement and the Fed assures the markets that they're going to continue to provide easy money, keep interest rates at record low levels, that could create the kind of an environment where investor sentiment remains positive, where the dollar is being put under pressure on stronger risk appetite, and that, as I said earlier, could also provide the necessary catalyst that the euro is going to need in order to challenge that 2012 high and potentially break above it, above $34.85, and generally speaking, the large quarter point, $1.35. The last two of the top 10 events next week will be the Consumer Sentiment Index, which, by the way, the Consumer Sentiment Index was a little bit lower than expected for the month of January. This is the revised estimate. It is expected to stay around there at 71.4. Pretty significant decline from above 75 in the previous month. That could be a little bit of a softer economic report from the U.S. And then the ISM Manufacturing Index, which is a leading indicator of economic conditions in the U.S., measuring activity in the manufacturing sector, is also expected to stay up positive above 50, as many of you know, indicates expansion. A reading below 50 for these purchasing managers indexes indicates contraction. So as long as an index is above 50, that means that the sector is expanding. We're expecting that we're going to see next week a reading of 51 from a reading of 50.7, so staying in expansion territory in the month of January, the ISM Manufacturing Index. So I'd like to invite you, that wraps up the list of our top 10 spotlight economic events. As I said earlier, it's going to be all about the dollar, the state of the U.S. economy, and the Fed's future monetary policies next week. I'd like to invite you to join me and listen to my daily All Things Forex broadcast on my website, allthingsforex.com. Thank you to our friends at fxstreet.com for hosting these series of webinars. Thank you all very much for joining me today. Have a great day and a great weekend. And I look forward to seeing you again a couple of Fridays from now. No webinar next Friday, but I will see you again on, Friday, February the 8th. All right. Thank you very much again. Have a great day and a great weekend.